starting to have a good afternoon. Welcome to 2025 and the Business BoardCast. Today, I am delighted to have Alan Charlotte from Chelsea Corporate with me. Welcome, Alan. How are you?
Thank you very much, Nicky. Happy New Year to you, and welcome everyone to 2025, as Nicky said.
Absolutely. So, if you're a regular watcher of this, you'll know that we like to take live questions. So if you are working today or just popped on for watching this live, please do say hi in the comments and ask your questions. If you're feeling shy, don't worry. We're very happy to take questions personally afterwards if you want to contact us via LinkedIn. But we do love having them live, because usually if somebody's asking a question, you bet most other people are thinking the same thing. So what we were talking about today. So Chelsea Corporate, they focus upon advising businesses that are looking to buy other businesses, so looking for either acquisitions or mergers for their groups. So Alan is head honcho there, so he's the perfect person to ask. So what we're going to do today is going to talk a bit about market conditions. We're going to talk very specifically about what is a buyer looking for when they want to acquire your business, and then we'll talk a little bit about what are the hot and cold sectors as well for 2025. So Alan, what are you seeing and expecting to happen in the market for 2025? Is it busy, quiet? What are you thinking it's going to look like?
Nicky, thank you very much once again for inviting me to this broadcast. I really appreciate it, and I hope everyone has made a good start to 2025. As you said quite rightly, we work for buyers of businesses. We help buyers with deal origination and deal execution. We've been doing this for a good number of years now. For over 13 years, we are headquartered in London. So market conditions for 2025. Well, I have to say that the second half of the year last year was incredibly strong. So that momentum that we saw building up in the second half of the year, which incidentally coincided with elections and new Labour government here in the UK, I think stabilized market conditions. The sort of inherent risk that was in the M&A kind of went away. And we've seen a very, very strong year. So the calendar year 2024 was the strongest that Chelsea Corporate has seen in its history. So it was a very, very busy year, both in terms of the number of deals, but also in terms of the size of the deals that we've done. And I believe that momentum that we saw entering or late last year and now beginning of the year is very, very strong. And I believe that market conditions will remain very, very buoyant. There's no doubt about it. And I say this because when we look at the pipeline, for example, of the deals that we are working on, the new clients that we have onboarded suggest that 2025 will be a very, very good year for M&A transactions. But there are a couple of other factors, a few other factors, I should say, that I believe will drive the activity as well. So I mentioned interest rates. We've seen them coming down slowly. There'll be hopefully more of that drop in the coming months and quarters. The reason I mention interest rates is because it makes it easier for buyers of businesses to raise funding necessary to acquire businesses. So that will drive the activity. Also, what we've seen is that the couple of changes to taxation, the business asset disposal relief, the rates are going to change from April of this year from 10% to 14%, so another 4 percentage points increase. Another increase will be next year in April 2026. So essentially, business owners, especially those at the lower end, will be looking to beat these deadlines. So I think it will certainly increase the activity in the first few quarters, certainly in the first quarter of the year, but also beyond as well.
Absolutely. I'll just sort of expand on that a little bit for anybody that's not sure about that. So when you sell your business, generally you've got capital gains tax to pay.
Right.
However, what you've got is they used to call it entrepreneurs relief. It's now business asset disposal relief. So that if you have a £1 million lifetime allowance, so if your business is £1 million or more, sold your share of it, you only pay at the moment 10% on that. So I normally use the idea that, often you've got a husband and a wife, or a husband and husband, or whatever else in your business. So, if you've got a £2 million business and you're 50-50, that increase is going to cost another £80,000 in tax. So it's quite significant for people that are selling. That's why that I do expect to see certainly a lot of the offers that we've got on the table. I'm pretty sure that most of the sellers will be looking to make sure that they're completed before April to secure that lower rate.
That's right, Nicky. And another factor that I would add to it is that a couple of factors. In fact, we've seen increasing interest from buyers outside the UK. So they find the UK market very attractive, both in terms of valuations, but also the opportunities as well. And we have this natural, essentially retirement, business owners looking to retire and sell their business. So all of these factors put together, the baby boomer generation is driving the activity, and I believe will drive the activity further this year and beyond as well.
Absolutely. So so the key things: CGT rates gradually going up more, which is going to drive people to get their sales through this year or next year. There's interest rates at the moment going down, so that's making the buyers more active. And then we were also talking before we started, when we went live, we were talking a bit about the economy in general. At the moment, it's sort of flatlining a little bit. It's looking it's either going to be a very small growth or flatline, or it could be a potential low growth. We're not quite sure the sense of how that's going to affect M&A as yet. I'm thinking it's not going to have too much of an impact. But we'll have to see, as long as it doesn't dip down further, and that could go. But there's always winners and losers in these things. So what we're here for today is, what are buyers looking for? So you're speaking to buyers every day, Alan. What are the key things that they're looking for?
I think specifically, if we look at the sectors, there are certain sectors that are very, very active, and we've seen most of the deals coming from these key sectors. So IT services, MSPs, for example, are very, very popular with buyers of businesses. So there's a lot of activity around that. Manufacturing, engineering businesses, these tend to be heavy, asset-heavy businesses. They are generally very attractive to buyers. Relatively easier to fund against the assets as well. So they are very attractive. We've been involved, for example, in a number of deals in e-commerce, fulfillment, logistics, transportation businesses, haulage, but also professional, services, financial services companies. I think if we are going to look at this year and beyond, we've done quite a thorough study of the recent budget, for example, back in October of 2024. So we looked at where the money is going as far as the government spending is concerned. So there are some key sectors that we believe will benefit from the boost in spending. So some to mention are, healthcare provisions, for example. So a lot of spending going into the NHS. So providers of services into the NHS, I believe, will benefit. There's been a lot of talk, and there's a continuous talk here in this country about construction of new homes. Lots of governments, as you know, in the past have tried to tackle this issue of severe shortage of new homes, for example. The Labour government has a strategy there as well. So I believe construction-related services will benefit as well. Building services companies will also benefit. A couple of sectors to mention also. I mentioned IT services. That is likely to see a lot of additional activity in terms of M&A. Going forward, quite a lot of money is being spent on that front, but also renewable energy as well. It's all about reducing carbon emissions, as you know, both from the industrial groups, for example, but also at home, etc. So there'll be relief and subsidies, for example, for businesses, for for buyers in this space. So these are some of the key sectors where we are seeing, and we've seen already interest. So growth and interest is likely to be in these four or five sectors, I would have thought.
Yeah, absolutely. I concur with that. Yeah, and certainly like professional services, there's still a lot more consolidation to do in that area. And that's where, there's a lot of backers and PE firms, etc., that get excited about that, because it's quite simple consolidation, really, that they can see their multiples increase quite quickly when they make their groups bigger. Okay, super. So when they're looking at a particular sector, what key attributes are the buyers looking for?
That's a great question, Nicky. And there are some key denominators, if you like, across sectors. So buyers are mostly, the buyers that we talk to and we've been talking to for years now, are mostly interested in, I would say, value, stability, the growth potential of the business, but also alignment with their strategic objectives as well. So if you look at, for example, profitability, they would like to see a strong EBITDA margins, but also consistent EBITDA margins. They would like to see net income growing consistently, and crucially, they want to see positive cash flows in the business as well. They are always looking for businesses where they can minimize the risk. And those businesses that have, for example, high recurring revenues are likely to be more valuable to sellers, but also to buyers of businesses as well, because they are perceived as less risky. But something that is also niche, has a competitive advantage, again, is going to be really important. And the diversity of the customer base also is something that buyers will be very keen. So something that doesn't have a high concentration in too few customers, for example. So these would be the key things I think that will be of interest to buyers of business. And ultimately, finally, if I can add, the deal structure is also very important, meaning that if you, as a seller of the business, are able to provide flexible deal structure in terms of payments, for example, earnout, seller finance, you'll be more attractive to the buyer of the business.
Absolutely. I always say to the sellers, it's a real toss up between, if you're wanting to de-risk it and have your money on day one versus the potential of, if you're happy to agree earnouts, etc. Yeah, it's a long period of time, but hopefully there's much upside. So often you'll find which are the more risk averse or confident in their business, because hopefully if they're really confident in their business, they're not going to worry about an earnout. But of course in some sectors they will only go for earnouts, etc. However much they might read all these articles about people paying everything on day one, they are few and far between, the buyers that will do that. Super. Okay, so a thing that I wanted to highlight was, when we're going from the, you're representing the buyer, I'm usually representing the seller in these situations. And it's the frustration of course, often you're seeing the buyers all get excited about the historical profits. The sellers are going, but we've signed up all these contracts, we've got all this momentum going, we're excited about the future profits, and that's what we should be selling upon. So what's your sense of, or how do you justify that with your buyers?
Well, it's another great question, Nicky. So effectively, buyers will always, in my view, and certainly the buyers that we work with, will look at future profits. What are the prospects of the company? But remember that the potential might be great, but also we need to provide some evidence, and we need to be comfortable that what we are paying for the business it can be justified with the historical performance of the business. So if you have a business that is long-standing and they can demonstrate obviously profitability over a period of time, positive cash flows, the growth that I mentioned earlier as well, that will give us as buyers of businesses a lot of confidence that, look, there is enough evidence here to suggest that this business is going to continue to grow and be profitable going forward. Other factors that I believe will be very important is, of course, the structure of the team, the management team in place. Eventually, the owner will leave the business after the handover period, but we really need to rely on something. So historical figures will give us the confidence, but the future is what we are looking for in the business that we are looking to buy. The future profits, that is.
Okay, so essentially both are very, very important. That's
Absolutely.
We need to be able to say the full story. Okay, so this is going to be really key, important one, what everybody's going to be on the edge of the seats waiting to hear your answer.
Yeah.
What things will make the buyer push up their valuation and push up the price of what they're willing to pay?
Another great question, Nicky. I believe there are a number of factors. So first of all, the larger the business, the more valuable it will be in terms of the absolute value. Also, as you move in terms of higher, in terms of the size of the EBITDA, the multiples tend to increase as well, because the business is perceived as less risky. If you have a period of, I think, long-standing businesses, by long-standing, I mean businesses that have been around for 15, 20, 30 years, they will have a long history, of course, but also strong customer relationships, likely to have high recurring revenues. These businesses will be very valuable, much more valuable to buyers than perhaps a business that doesn't have those attributes. I mentioned earlier the management team. So if you have, let's say for argument's sake, a manufacturing business, and we did a lot of deals in the manufacturing space in the last year, as I mentioned, if you have strong operational director, sales director, marketing director, these are very important positions in the business. The low customer concentration is really, really important. If you have a business that is generating, strong margins, double digits margins, and they've been consistent in that respect over a period of time, it's going to make it very attractive to buyers of businesses, and they will be prepared to pay more than let's say a premium for those types of businesses, because they are perceived to be less risky. Also, remember, oftentimes buyers will need to raise funding for a portion of the transaction that they are looking to achieve, and lenders will also be looking at businesses that are stable, that have consistent cash flows, not just assets but consistent cash flows, and management team in place. So these will be the key elements in my view.
Okay, so that are interesting about the EBITDA levels. Obviously,
Yeah.
as they get bigger, then it becomes more valuable and gain the bigger multiples. So for the sellers out there, how is there any sort of standard things that they should be aware of? Is it, if they're at 250 now, should they be waiting around until they're at 300, or is it more that they've got to wait till they're at 500 or a million or something, and then that's when the multiples more significantly go up?
Great question again, Nicky. I think anything I would suggest less than 500,000 in terms of EBITDA, they are perceived by buyers as more risky businesses. They are likely to require, for example, the buyer to be involved in the business on day-to-day basis, essentially replacing the owner of the business. But also the margin for error is lower, meaning that if they lose a contract, a significant contract, for example, it could have a significant impact on the EBITDA of the business. Also, what you tend to find with those businesses that have around 250,000 in terms of EBITDA, for example, or up to 500,000, they have a light second-tier management team in place, for lack of a better word. So As you move higher in terms of EBITDA absolute value, then the multiples tend to be higher as well, and hence the business that you own, that you're looking to sell, will be more valuable to you.
Absolutely. But I also sort of like mention to the sellers, if you're trying to get from a 250 to a 500,000 business, that's quite a big step change. So you've got to really work out how long is that going to take you, and whether there's alternatives that you'd rather be doing, whatever. But that's also why there is so much consolidation. And often we do have some of our sellers think, well, actually, I want to do one or two little acquisitions myself before doing my full sale.
It's a good strategy to have as well. It's a good strategy, and it's the fastest way that you can increase or double that EBITDA figure that you mentioned earlier.
Absolutely. But the focus is, of course, on the profit. That is really important. Unless it's a very sort of early technology type thing where people are excited about number of users and getting entry to the revenue, unless you're in that sort of area, profit is the important thing rather than revenue. People are going to get more excited about a £10 million business. Oh, actually, what was I going to say? They'll get more excited about a £5 million business with a 25% margin than a £10 million business with a 10% margin.
Correct.
25% versus 10%. Essentially, they're looking at the profit. That's the key thing they want. That's more exciting to them than, although have done a deal with a low margin business this year that still did well last year. Now it is still possible in sort of facilities management, security, that kind of area. It's all about volume of deals, isn't it? Because
the scale, really. You're right.
You're very low margin businesses.
Yeah.
But that's also why they've been very hampered when the interest rates were higher, because then it was much more difficult. If you're trying to buy a business that's only got, say, a 10% net margin, and the interest rates of what you're actually going to be able to borrow at is more like 12% or something, it's just not going to make sense to do it. Whereas when we get the rates down and you can borrow at 6 or 7% or something, it's more possible to do that kind of deal. Okay, the other thing we were mentioning on this I'm really interested to hear about this, the stories, is due diligence red lines, the sort of things that you've seen where your clients got excited about the deal. They thought, yes, this is a great business I'm going to buy, start the due diligence, and then something goes horribly wrong. So what are the sorts of classic things that you see that the sellers need to be aware of and make sure that they can try and avoid?
Yeah, well, there are a number of the red lines that we encounter, Nicky, during this process, and they can fall into different categories. So, for example, if we look at the financial red lines, for example, you end up in situations where you have undisclosed liabilities. And if we take a step back, and if you think about the process of selling your business, we as buyers, we're always looking for that integrity in every sort of communication that we have, with the transparency with the sellers. There might be situations where when themselves they were not aware of any sort of liabilities, and the due diligence is obviously there to unearth these. But it's so important that there is that transparency from sellers of business. So you can have those undisclosed liabilities. You can also have revenue misrepresentation, and that's a massive red line. So you told the buyer about certain figure in terms of your revenues, and it turned out that that's not really the case, and you knew that's not the case. That is very likely to affect the deal. We had the situation very recently. This was last quarter of the year, where a big evaluation really was hinging on the contract that the seller was waiting to renew with a major customer, and it was more than 25% of the valuation of the business. So As a result, what happened is that the deal went through and successfully concluded, but it delayed the process during that due diligence process. So being prepared for these kind of elements is really important. If you look at other things, for example, that are red lines in the due diligence process, are for example, the legal aspects of it. So if you have a pending litigation, for example, or if there are issues with the IP, if you look at some of the SaaS businesses, for example, quite a lot of them rely on the IP, and if there are issues with that, and if there are disputes, then it could affect the deal massively, and the deal probably is likely to fail. Also, what you tend to have is regulatory issues. So if you have FCA firms and there is an issue with that, or if you have other firms that are regulated, for example, pharmaceutical businesses or chemical businesses, and they are non-compliant with some of those elements, then that is likely to affect the deal and kill the deal ultimately. Other things to mention here, just very briefly, is of course operational.
Yes, we've got some questions as well to fit in a second.
Absolutely, that's wonderful. Couple of other things to mention is, of course, operational. Strong leadership team. It's very, very important. Reputational risk is really important. If during the due diligence process stuff comes out that puts a massive question mark on the reputation of the business, on the reputation, for example, of their products that they're selling, or the team, the people that provide these services, that is going to affect the seller's perception of the deal, and is probably they're likely to walk away. So these are the sort of things to really be aware of.
Yeah, absolutely. So sort of key things I've seen recently as well is, if you've got a lot of contract revenue, make sure the contracts have been renewed recently, so you've got a longer run-off time, because that's buyers don't like it if they're all going to have to be renewed in the next year. Also, any numbers that you're presenting, yes, you might have different numbers between your management accounts and your statutory accounts. Make sure if you're showing anything that is different to your statutory, you've got a very clear audit trail of how it's different, because otherwise that freaks out the buyers, because they get confused and they start not believing the numbers. But questions. So we've got a couple good ones come in. So Nick asks, should business owners be conscious of buyers who are borrowing a large proportion of the sale price? Interesting question.
A very good question, Nick. That's a really, really good question. I don't think so. That's the short answer. I really don't think so. Remember that lenders do a massive due diligence, a very, very thorough due diligence on the borrower. And also they are going to do, obviously, a cash flow analysis of the business that the buyer is looking to acquire. So the fact that the lender is comfortable with the cash flows of your business as a seller, projected cash flows, the operation of the business. Remember what we spoke about earlier about having that good historical performance of the business. That gives a lot of comfort to the buyer, a lot of comfort, to the seller as well. Nick, it was right. Another part which is really important is the deal structure as well. How much will be paid, for example, on completion of the deal? How much will be deferred? What terms, etc. But remember, you want to have a large cushion in terms of the EBITDA. So the EBITDA going forward should be able to cover the payments to the lender, the interest payments, of course, but also any deferred consideration as well. So the short answer is no. And the chances are that a lot of buyers out there will try and leverage as much as possible to de-risk the transaction. But we need the leverage in order to be able to do the deals.
No, absolutely. I would just sort of echo that. Actually, if they can borrow money, that's a good sign, because they've been through that process. I think what Nick's probably also thinking of, though, is the sorts of deals where the buyers are intending to make most of the payments from the cash flow, so they're actually offering very, very little. So you do get some let's politely call them chancers, who are offering basically nothing day one and want to just pay it from your cash flow going forward. So they're not actually putting any risk or anything in themselves. Those are the sorts of buyers you've got to be very, very careful of.
I agree with that. You've got to be aware of those. Ultimately, you've got to really make sure that the business, whatever the amount is being borrowed against the cash flows of the assets of the business, is able to sustain it. Generally, the sellers will feel more comfortable if there is more of the equity coming in from the buyer of the business. But another factor that is going to drive that is obviously the structure of the deal. As I said, the type of the deal, the sector that you're in as well, because buyers will not be able to, they will be able to borrow up to a certain amount against the assets and the cash flows of the business. For example, businesses that are asset light, then there'll be more of a requirement from the buyers to put more equity up front. So that gives hopefully the comfort to the sellers that, look, there is skin in the game here from the buyers as well. And it's not a kind of pure leverage buyout kind of deal.
Absolutely. Well, I think we covered lots and lots of information there. That was really great. Thank you so much. An excellent start to the year. Our future speakers got a lot to live up to. So thank you so much for your time, Alan. If anyone would like to contact you, they can contact you. You're easy to find on LinkedIn, or obviously called Chelsea Corporate. That's good for you, isn't it? LinkedIn?
Absolutely. LinkedIn or Alan at chelseacorporate.com. I look forward to connecting with all of you. And again, thank you so much for inviting me to the broadcast. And I hope you have a fantastic and very successful 2025.
Excellent. Thank you so much. So our next business podcast, 2 weeks today on the 17th, and we'll be joined by Nick Babington, and we'll be talking about the latest employment HR law changes from Corona. So he will give us all the information. He's been on before, so he always has lots of good anecdotes of HR disasters and how to mitigate them in the workplace. But anyway, thank you so much. We've got lots of other things lined up for this year, so please do book in. Do let me know if there's anything you'd like covered later in the year, whether it's in accounting, employment law, or anything to do with M&A. Very happy to cover, whether it's from a succession planning or Greenwich accountant's perspective. Right, thank you so much. Have a wonderful weekend, everyone. Be careful if it's snow where you are over the weekend, and have a fabulous weekend. Thank you.
Thank you all. Bye-bye.